bring the meeting to order. Would you do a roll call for me, Linda? I don't see Linda in her usual spot. Let's see.
I'll go find her.
Okay. And then Trustee Rue, as a heads up while you're munching there, I'm going to ask you to do the Pledge of Allegiance for us once we do the initial roll, if you don't mind.
Let me just.
All right. If you wouldn't mind doing the roll for us, thank you.
Sure. Okay, Miss Ginsburg?
Here.
Miss Me?
Here.
Mr. Green? Mr. Rue?
Here.
Miss Martin?
Here.
Mr. Gatto?
Here.
Okay, Mr. Jones?
Present.
Okay, and Mr. Fain?
Here.
Staff participating in the meeting include the following: John Grable, Chief Investment Officer, Santos Kryman, CEO, Jude Perez, Deputy Chief Investment Officer, Stephen P. Rice, Chief Counsel. We have the following investment staff participating today: Christopher Wagner, Jim Rice, Derek Kong, Amit Agarwal, Bache Masarajian, and Catherine Tan. There's also going to be a presentation which is going to include Laura Guglielmo, Richard Bendel, and Ted Granger. We have several consultants group on site. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we may proceed with the agenda.
All right. Thank you very much, Linda. Again, welcome and good morning to everyone. And Trustee Rue, if you wouldn't mind leading us in the Pledge of Allegiance, that would be appreciated. Thank you.
If everyone could stand, put your right hand over your heart. Ready, begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, great. Do you want to go ahead and read the teleconference?
Yes, Mr. Gatto, can you please confirm that there's nobody over the age of 18 with you?
Yes, I confirm.
Thank you. And Mr. Jones, can you please confirm that there's nobody over the age of 18 with you?
Yes, I can confirm.
Okay, thank you.
All right, so then moving on to the minutes from the April 10th meeting. Do we have any amendments or changes or anything of note from that? And if not, can I get a motion to approve?
So
Second.
Okay, Mr. Fay made the motion. Mr. Jones, Mr. Green seconded. Ms. Ginsburg?
Yes.
Ms. Me?
Yes.
Ms. Martin?
Yes.
Mr. Green?
Aye.
Mr. Fay?
Aye.
Mr. Gatto?
Aye.
Mr. Rue?
Yes.
And Mr. Jones?
Aye.
Okay, the motion passes unanimously.
All right, super. Linda, do we have any public comment?
We do not.
Okay. So we'll move on to our executive update and to kick it off with our CIO, Mr. Grable.
Good morning, Mr. Chair and trustees, and a special thanks to Amy Boris for the excellent corporate governance committee meeting that we just had. Amy and CII, as we heard, are key partners to LACERA, and I'll point out a couple things. One, a thank you to Dale Johnson, who is part of our governance team. Dale is an active member of the proxy voting group that Amy referenced during the presentation, and Dale has been part of that group, really advancing LACERA's interests. The other thing that, and maybe I'll go off script in saying this, is when Amy was talking a bit about the origin story of CII in response to the era of green mail and the corporate raiders, it's not lost, or it shouldn't be lost on us, that, across town earlier this week, the Milken Conference was gathering. And, maybe I'll just leave the comment there. If we can go to slide 4, please. So slide 4, I'll talk about this slide in the context of today's meeting. This is the performance of global markets as of the end of April. First, I'll note, though, that major capital markets had a very different April than the first 3 months of 2024. As we can see in the top left and the top right, the global equity markets and the global bond index. Broad equity markets were down over 3% for the month. The price on fixed income securities also trended down as yields rose during the month. What I'll talk about on this slide is that today we have a recommendation for ranges around the updated asset allocation targets that the board approved last month for both OPEB and the pension. And as we can see on this slide, on the chart, on the rows in the table on the bottom, where we show a variety of markets, the subcategory, and the performance from the month to a 10-year annualized, that markets are anything but static. They vary a lot. So if we look, for example, over the past month, U.S. REITs, which is at the very bottom, real estate index, that was down 7% for the month, compared to commodities, which were up 2.7% for the month. So that's a 10% differential. If we look over the last 12 months, U.S. long-term treasuries were down 12.2%, whereas U.S. large cap stocks were up 22.6%. So that's a 35% differential. And the point in mentioning this isn't that, I can do math. It's that this is very instructive to the discussion about the ranges around our targets. The BOI establishes in its asset allocation targets. However, as we see on the slide, that markets are dynamic. And as a result of that, we have to add ranges, because absent ranges, we would continuously be buying and selling securities, which isn't practical. It's a lot of transaction costs, as well as a false sense of precision around our strategic asset allocation targets, because we hold securities that price with different intervals. We have some, like public stocks, which may change in value on a tick by tick on a trading basis, whereas we have other instruments that, like private equity, for example, that is only priced quarterly or valued quarterly. We also have investments that are illiquid, and that really complicates our ability to rebalance. So today we're proposing bands around the strategic asset allocation targets, because capital markets are dynamic, as we can see on slide 4. So if we can move to slide 8. On slide 8, this is something that Amy mentioned on one of her slides, and we're probably way too late, but we added in the what to watch column on the right, artificial intelligence. And if I plug into the AI engine, what to watch for an investment portfolio, AI comes up. So, it has implications within our portfolio. It has much broader economic and societal implications. We're still early in the story. It will develop, but it's something that if we were to color code what we would be watching over time and what is more permanent, AI probably is one of those things that will be on this slide maybe for at least the duration of my career. If we can turn to the next slide. So this slide shows the results for the pension as of March 31st, the end of our fiscal quarter, our third fiscal quarter. We hit, as we can see in the bottom left, a high water mark for the pension of $78 billion. I will note, as we saw in slide 4, that it will be down in April. We'll give a little bit of that back. In the bottom middle, we could see that cash is at $1.2 billion as of month end. And in the top middle, we added a new chart, upside, downside capture percentage. We could see there's some columns, and in a box, 75 over 57. So I'll explain what that means, or at least I'll try to. So what this chart does is compares the performance of the fund on a rolling 36-month basis, and we'll add some footnotes next month. We're experimenting with what goes into this chart, but on a 36 rolling month basis to a reference portfolio or a proxy of a diversified portfolio, and in this case we're using a 60-40 portfolio, 60% stock, global, the ACWI IMI, our benchmark, and the 40% being the Barclays Ag fixed income, once again, our fixed income benchmark. And that's what we show on slide 4 as a reference portfolio. So to go a little more detail into both the upside and the downside aspects of this. So if a 60-40 portfolio was up in a rolling 36-month period by $1, the LACERA portfolio would be up 75 cents or 75% of that dollar. So that's called the upside capture percentage. In contrast, if the 60-40 portfolio was down by $1, LACERA's portfolio would be down only 57 cents or 57% of that. That's the down capture ratio. So the way to think about those numbers is an upside downside capture ratio greater than 1 is very good. In this case, it's over 1.3. If we divide 75 by 57, it's greater than 1.3. So the key message there is our portfolio does a very good job of mitigating risks. And that's what we want. We're a mature pension, we're cash flow negative, and the hardest dollar to pay benefits with and to invest is a dollar that we don't have. So we've seen the benefit of this very attractive and positive upside downside capture ratio over the last 5 years where we've had significant market volatility.
I have a question real quick. Sorry. This is great. So that I just want to say this is awesome. Is there a thought on using something like this with our full with our full benchmarks later on? So like right now this is 60-40, but eventually we'll be able to have all of our benchmarks like put into this, because I think if we keep on focusing on this number, this is excellent.
Yes, Mr. Chair and Trustee Fay, we probably have some of this already in the quarterly performance book where we have much more comprehensive risk analysis. But yes, I think that using proper risk metrics to identify risks in the portfolio to show prospectively how we can best position ourselves to construct the portfolio against that, as well as to assess how we're doing, absolutely. Because once again, I think that the naive approach of just looking at returns only really minimizes the important task that we have of paying retirement benefits, once a month. If we were just to look at the portfolio every 40 years, you wouldn't have to worry about, what happens, the ins and outs of the market. But we have to do this, on a near daily basis. So absolutely. And if we could go to slide 10. This slide shows the results for the pension and OPEB through the end, once again, of our third fiscal quarter. As we can see in the top where it highlights the pension was up 7.4% fiscal year to date. Given that 7% is our target long-term number, 7.4 is very attractive. Once again, we'll give some of that back in April, as April is a down month. I'll note also on the top, if we look at credit, Fiscal year to date and over the last 12 months, credit is our best performing asset category. Once again, highlighting the need to have a diversified portfolio because you never know what asset categories are going to perform in any given market environment. At the bottom, the OPEB trust, it was up 2.1%, 3.4%, and 9.5% for the month, quarter, and fiscal year to date. Recognizing that the OPEB trust has a actuarial target of 6%, so fiscal year to date strongly ahead of that. OPEB also hit a high water mark of $3.8 billion as of the end of March. The market drawdown that we had in April will be much more noticeable with the OPEB market valuation. And with that, Mr. Chair, I'm happy to pause for questions.
Gotcha. Any additional questions to Jonathan's report here?
I do have a couple minor comments, Chair.
Okay, go ahead, Trustee Mead.
Thank you. On the same slide, just want to add a comment there, slide 10. I was wondering why the overlays and hedge doesn't have performance measure on the 1 year. For all other I want to have it. So John explained to me, just in case anyone have the same question. It's on. Yeah. So John explained to me, in case anyone else may have the same question, looking for the same performance data. The reason it's not there is because we don't have a location in that category. It's not an assets category. It's just a pass to, cash when we do the rebalancing act. Is that right, John?
Yeah, Mr. Chair and Trustee Me, the overlay and hedges is our fifth functional category. It includes our currency hedge as well as the cash overlay. There is a 0% target allocation to it. As we can see in the IPS and later today in our benchmark discussion, there's no assigned benchmark to it because it's just used to capture the performance of overlays as well as hedges. With that said, all activity from those overlays and hedges is captured at the total fund level. So in terms of the total performance of the fund, it is included there. It's also in the monthly CIO report, I believe on page 18, where we show the monthly performance of each, and we also go into more detail in the quarterly performance book.
Thank
So
you.
the one last point is that putting a monthly number, it's given that there's no benchmark, it would just be what we call misfit. It's not really instructive in terms of providing insight into the portfolio.
Thank you for sharing with everyone. One more comment on page 14. So page 14, we have 5% of allocation in the rest of the world, right? That's a breakdown in the global investment. So I do have the interest of wanting to see more breakdown of that. I was assuming most of it is in emerging market. I think emerging market investment today is very important. One is for diversification, different market. Second is that there are many countries that do have exponential growth, so make sure we need to capture those growth. So I want to see breakdown what country we invest in that 5%.
And Mr. Chair and Trustee Me, I think, yes, we can provide the information. As we show in the footnote, there will be a list of, as we heard this morning, we vote our proxies in 60 countries. We'll have a list of 60 countries or more where we have small exposure. According to our investment beliefs, we are a global investor. We all believe in the importance of a diversified portfolio. I think that there's some aspect to this slide that, once again, maybe false precision, that this is based upon country of domicile where a company's headquartered. So if you look at, within that 70.7% domiciled in the U.S., the 500 largest U.S. companies have a majority of their sales outside the U.S. So it's not necessarily that the economics of the fund are 70% are in the U.S. It's much more diversified than the country in which a company is headquartered. A couple other thoughts are that that whenever we're in some sense driven by our benchmarks. So for example, the ACWI IMI, which is our global equity benchmark, 5 years or so ago, that was maybe 50% domiciled in the US. Today it's 60%. And that is a result of dramatic outperformance by US markets really over the last decade. So if you look at, if we were to pull up slide 4 again, we don't have to. If you were to compare on an annualized 10-year basis, okay, thank you. Where it says US large caps under equity, under 10-year columns, 12.4%, you go down a couple lines to emerging markets of 3%. So that's near 10% annualized outperformance by US markets. So if you were to annualize that, a dollar invested in US markets over that period would have maybe, over $2 in profits compared to emerging markets where it would have, maybe 30 cents of profits. So I think that we need to invest globally, but we also need to be compensated for all the risks that we take in the portfolio. And that's something that we try to do each and every day as we, adhere to our benchmarks, as we look at different risks, be it currency, illiquidity, accounting, the vibrancy of capital markets, as well as sectors. I mean, there may be some sectors in some economies which are less growthy, less valuable, and may be sectors that may not truly represent where the global economy is growing. So, but absolutely, we can provide details.
Thank you.
Thank you for that that distinction. That was an important distinction, I think, to make. Any other questions to John's report here? All right. Being none, thank you very much again, Jonathan. All right. Next up, we've got our member spotlight. I assume JJ is sitting there somewhere. No.
Good morning, Chair Jones. I'm Laura Guglielmo, Assistant Executive Officer.
Oh, I see. Good morning, Laura.
With our business services group, and I'm sitting in for JJ Popowich, who is with you at Zachars. So today's member spotlight is Tina Young, and I'm really excited to announce this. This is the time of the meeting where we highlight one of our members, and highlight their public service. And it's a reminder of why we are here, and why the role that we play as an organization. So today's member spotlight is Tina Young. She's a LACERA member, so we're really excited about that. Tina is a human resources analyst in our human resources department here at LACERA. We are recognizing her for her 32 years and 9 months of service, and she is retired last month in April. Tina's impact on the organization at LACERA is especially profound because she's helped to really bring in the best and brightest here at LACERA as a recruiter. Her last recruitment was our 2024 retirement benefit specialist class, which are currently in backgrounds, but it really goes to highlight the long-term impact that she will have. Those folks, we hope to have a long career here at LACERA, and Tina was responsible largely for helping to recruit them along with many others. So we are excited about that. I also want to highlight that her role here at LACERA has really been significant in a number of ways. She is one of the co-founders of our employee council team, and really highlighted and supported diversity, equity, and inclusion efforts at LACERA throughout her career, in part by her co-founding of the employee council team, but also their work in our cultural diversity luncheons. She spearheaded our Black History Month movie events, and also assisted in coordinating our holiday parties, really building that culture of community here at LACERA that we appreciate. Tina, like many public servants, doesn't just do her public service 9 to 5. She's had a long history of volunteering at her church as a 12-step counselor, a mentor, an inspirational speaker for the women's ministry, and she plans to continue that work in her retirement. So we at LACERA would like you to join us in congratulating Tina Young on her retirement.
Yeah. Congratulations, Tina. She must have started when she was 5. She looks so young. Okay, beautiful. And then so next up then Santos with our CEO report.
Yes, Chair, trustees, good morning. Very brief CEO report. Just wanted to remind the Board of Investment Trustees that the Board of Retirement will be having their offsite in Long Beach at the Westin Hotel on Tuesday, May 28th and Wednesday, May 29th. You're all invited to attend, and we have a...
help you find emails. Look up.
We can, I probably can use that help. We have a very, good program put together. Day one will be pension member service focused, and day two is really going to focus in on retiree healthcare, which is definitely the majority of the calls that we receive are really retiree healthcare related. Very complicated field, and so we're going to try to, open up the black box and let you all take a peek in to see what we deal with on an ongoing basis. I know that later on today, as part of a closed session, we're going to have a pretty detailed discussion about recruitment and our efforts to hire individuals for the investment team as well as the legal team, and so I'll reserve my comments for that. But before I move away from that, I did want to introduce Avi Harescu, our investment attorney. There he is back there. He's going to be working in private equity, so he's joining Christine Rosland and Mike Brogan on the investment legal team, and so we're happy to welcome him aboard. I believe he started mid-April, and so this is the first opportunity he has to meet you all.
Yeah, welcome. Welcome very much.
Yeah. I also wanted to highlight that we did receive from the executive office and the county the schedule for the election, the upcoming election for the third member of the Board of Retirement and Board of Investments. Those two seats are and the Board of Investment, it was occupied by Herman Santos, and so there'll be an election. This particular individual will serve out the rest of Mr. Santos's term, as well as another 3-year term. And so the Board of Retirement, that particular seat is held by Vivian Gray, and so there will be an ongoing election. And I just wanted to highlight a couple of dates for you all. The nomination period for both seats begins May 22nd and goes through June 21st. The actual election period will begin on August 5th, and it'll run through August 30th, and that's when the voting will end. We should have preliminary results sometime in mid-September, and the Board of Supervisors are expected to certify the election in late October. And so that is the brief timeline that we received from them. And of course, LACERA will be assisting with sending email blasts and reminders to our members that the election is ongoing and that their vote does count. I also wanted to recognize and let you all know that this week is actually Public Service Recognition Week. And so I wanted to make sure that I thanked all of our staff for all of their hard work and taking care of not only our members, but also making sure that they're available to assist those members of the County of Los Angeles that actually do the frontline work, the sheriff deputies that keep us safe, the firemen that run into burning buildings, doctors, lawyers, teachers in the probation department, for example, that teach those individuals. There's just social workers that help with children and family services, and so the gamut of services that are provided by our particular members is staggering, quite frankly, and they do it with a lot of dignity. and professionalism. And so I wanted to extend our appreciation to our members as well. So with that, I'm more than happy to stand for questions.
All right. Any questions for CEO Santos? Yes, Trustee Mee.
Thank you, Chair, and thank you, CEO. Want to join you to shout out to all our members for the Public Servants Day. Like Herman used to say, the sewer worker, working the sewer line every day. We thank them. They actually in our department, in my home department, Public Works. So, and then everyone else too. We have 194,000 members now, right? And thank every one of them for their service, and LACERA staff as well. Thank you for your service. And then I have a quick comment on the election. I read through the material, the procedure. I just want to say thank you to CEO. Thank you for the change. I see the effort there, the additional effort, based on my feedback from last election, that we want to reach out to active member more and effectively. I know last year was the electronic ballot, right? So emails easy to get lost. So I see you proposing to have paper ballots, right, this year.
Yes.
So it's a huge change, I think. That's hard to ignore, so it's a piece of information that I think will be effective, reaching to member. So thank you for that.
Well, thank you. JJ deserves a lot of credit. He was the one negotiating with the executive office, making sure that we did have paper ballots. And so we heard you loud and clear. And we managed to convince the executive office that a paper ballot would increase participation in our voting. Yeah. So, and we're looking forward to, there's actually, I saw the board agenda, there's a new executive officer that that was just appointed. I think the contract still needs to be worked out, but we look forward to working with him as well moving forward. So Edward Yen, I believe, is the new executive officer for the County of Los Angeles, contingent upon them negotiating a good contract. So
great accomplishment.
Right.
Yeah,
All right.
thank you.
Mm-hmm.
Any other questions for CEO Santos? Harmon? All right, thank you very much. Appreciate it. We'll see you a little bit later in closed session. All right, next up, under our consent items, we have the revised trustee education travel policy as approved by JOG-C. I guess that was just last week or maybe the week before. They don't run all together. Do we have any questions or anything from that, or do I have a motion to go ahead and approve?
Motion. I can start a motion.
Okay.
I will
Second, thank you. And then Linda, would you do the roll call?
Sure. Ms. Ginsburg?
Yes.
Ms. Mee?
Yes.
Ms. Martin?
Aye.
Mr. Green?
Aye.
Mr. Ray?
Aye.
Mr. Gatto?
Aye.
Mr. Rue?
Yes.
Chair Jones?
Aye.
Okay, the motion passes unanimously.
All right. Thank you. So we're moving along. I know we've got some members that are still trying to get to Santa Barbara, so I'm going to try and get you out of here in succinct fashion. But two very important pieces coming up here in our non-consent piece. So I think Jude is with the first group to talk about the policy benchmarks area, along with Makita. Again, I'm trying to look at the screen. I can't exactly see who else who's presenting. Tim. Okay. Got it.
All right. So good morning, Chair Jones virtually, as well as Mr. Gatto virtually, and the trustees within the room. Today we continue our strategic asset allocation study. So in your packet today, you should have a presentation from Makita as well as a cover memo from staff. John stole my introduction, but I'll still go through a little part of it during his CIO report. So at last month's meeting, the board did approve a new strategic asset allocation for both the pension plan as well as the OPEB trust. For this recommendation, we're asking that the board approve the investment policy ranges and the implementation plan outlined in Makita's presentation. So all of these items, this item and then the item after this, we've discussed in great detail over the last few months. And now we kind of just want to methodically capture these discussions with the last few recommendations in our asset allocation study process. So the recommendation in front of you today includes defining the investment policy ranges for each functional category and sub-asset class for both the pension plan and OPEB trust. As John mentioned in his CIO report, these targets establish ranges around the target allocation and allow for flexibility while acknowledging that market volatility, rebalancing, transition costs, and implementation factors can affect the weights around each functional category and sub-asset class at various times. So with that background, Tim and I, John, can stand for questions, or Makita can walk through the presentation.
Yeah, I'm certainly not going to repeat the introduction that I have in the presentation because I think it was very nicely captured by John and Jude here this morning. And as Jude pointed out, this is really just a mechanical next step in the approval process of the new strategic asset allocation. Setting ranges is a little bit more art than science, but we have tried to apply a quantitative methodology to it so that the ranges are understandable and comparable in between different asset categories. That said, we can jump right into the presentation and go through it, or we can address any questions. Open to you, and I know there's some time sensitivity, so happy to go either way. If you want me to walk through, I can. If you want to jump into some Q&A, happy to do that.
I would just like to move to accept staff recommendations for item A. And if anybody wants to see the presentation.
I do like to hear the presentation, especially when it's the first time for a few of us. So I think it's a great education materials, and then I'd like to hear, if that's okay.
Is there a second on
Yeah.
that?
A short
Yeah.
one.
Yeah, just the highlights, Tim, if you don't mind. And again, I think the important thing is this is just the evolution of the decisions we've already had, discussions we've already had. So now it's just getting into the numbers part. So the education isn't so much, we've kind of already had the heavy beast of it. This is now getting into like just the implementation level that's really kind of, beyond our competence as the board and more into the practitioner level of where the staff is. So, but Tim, if you could give us the highlights of that would be appreciated.
Sure, perfect. So maybe if we could just go to page 6, I can hit a couple of highlights there and then move through the rest of it in pretty succinct fashion. So ultimately here we have just an outline of the purpose of having ranges. And as both John and Jude said, it's really a tool to be able to reflect how dynamic capital markets are, but also still have the ability to control risk within the portfolio. So you do want to have bands on it, but you also want to be flexible enough to acknowledge that you're never going to be able to precisely hit all of the exact asset allocation targets. It basically will also capture any tactical asset allocation decisions. LACERA generally doesn't make those. The decisions when weights would be off of targets are more about the cost of rebalancing, although you do have a relatively efficient rebalancing mechanism in place through the overlays and hedges and the cash overlay that you utilize. But that only applies to the public market asset categories. So you really have to get a little bit more creative and thoughtful when you're incorporating a relatively high amount of illiquid assets into the portfolio, which the ranges also do. The other thing that I think is important to highlight in LACERA's approach is that you do use the functional framework as the sort of high-level risk control mechanism. So it's just an additional tool. There are a lot of other plans that use it, and we consider it to be best practice. But that does give you risk control of those functional categories in addition to the granular asset categories that sit below it. If we could go to page 8. So I already hit the art and science, but we did apply a couple of just general principles to this. So I'm going to focus on the bottom set of bullets. Functional categories are the primary tool for controlling overall risk. Each of the functional categories has some illiquid assets, so we think that having flexibility in the sub-asset category ranges is warranted, but you still should be managing risk at that functional category as the primary consideration. There are other things like certain asset classes have higher transaction costs in them, so that might be portions of the credit markets where bid-ask spreads could be quite wide when you compare them to sort of investment grade fixed income. So you have to be thinking about the cost of execution in addition to oftentimes when there are periods of volatility that make you look at rebalancing decisions. That could be some of the times where transaction costs are actually the highest, right? If markets are somewhat dysfunctional, bid-ask spreads tend to get wide in those environments. Trading liquidity tends to go away. So we want to have sufficient flexibility to account for those market conditions. Anyone have any questions on sort of the high-level concepts at work here? Okay. So maybe it might be helpful to just go through, we can do the pension growth policy ranges on page 9. And we'll just sort of walk through a little bit of the math and the mechanics and the transparency that we've provided here. So within growth assets, we have the 3 underlying categories of global equity, private equity, and non-core real estate. 2 out of those 3 categories are illiquid categories. So we've included our capital markets expected volatility, which is one of the considerations that we take into account. The more volatile an asset class is, shows that it can be riskier. But it also, in the case of illiquid asset categories, you may have to have wider ranges to account for that potential volatility plus the illiquidity. We've given you the previous range from the last asset allocation. We've given you the range size, also the numerical previous range. And then just to put it in context, how we're capturing that volatility component, looked at the percentage, the previous range percentage of the target. So essentially, how much are we letting it move away from the central point within it. Then we go into the new policy, the proposed ranges, all the same similar metrics. So I'd say on the growth assets, the one notable thing really here is that overall, the weight of the category is going down a little bit. That is primarily coming from a reduction in global equity, but also a reduction in non-core. Most of the ranges, I would say, are very consistent with what we did last time, as we're applying the same methodology to it. So tighter control, as you can see, at the functional category growth assets. If we're just looking at the right column, 17% around the center. Moving down to global equity, which is the most liquid of these asset categories, a range of around 24%. We basically kept the numerical proposed size range the same, despite the category going down somewhat in weight. Just because if you move the numbers tighter, it looked like it was overly constrained to us when we looked at it, but also to take into account that now public equity is a smaller portion of the overall category on a percentage basis, so you need a little bit of additional flexibility to account for the other illiquid categories being in there. Essentially, global equities will be the rebalancing mechanism within this group of assets. So that was the methodology overall for growth assets, and I think is a good example. So does anyone have any questions about sort of the math and what we did here and how we arrived at the conclusions?
I do have a question.
Yeah, go ahead, Trustee. Mm-hmm.
Thank you, Chair. You actually answered my question in your presentation. I was wondering for this category, this function categories, we have the largest overall allocation. So it's very important. And then I see your bullet points, the third bullet points there is important to control, right? Should be the tightest on the percentage of the target. So my initial question is that I see the growth assets, total 53% allocation now reduced to 48, but we keep in the numerical range, but the percentage range now is increased. So is that plus minus 8 is in the unit a million? Or was the unit in the range plus minus?
It's just plus or 8 in percentages.
In percentage.
Yeah,
okay.
so that's how you use that plus or minus 8 to achieve the 45 to 61, let's say, if we're looking at the previous range. You basically apply that plus or minus to the central point to arrive at the proposed range.
So basically what we had, the range in the current policy was already tight enough. If any more tighter will be just constrained us in execution, basically.
Yeah, and this is where sort of a little bit of the art versus science. I mean, we could have basically said, keeping growth assets at that same 15%, but then you would have had a bunch of non-round numbers essentially. So we expanded it slightly by sticking with the round number. But I also think it's appropriate, again, given that we have a higher percentage of the overall category now in illiquid categories. So like private equity, as a percentage of the group, it has a 17 weight, and the denominator previously was 53. The denominator is now 48. So you have a higher weight to an illiquid category that's hard to rebalance. So it does provide a little bit of additional flexibility, but not, it's a delta of 200 basis points.
Thank you.
Is it instructive to go through the other ones, or was that illustrative enough to sort of get to the punchline?
I think that accomplishes the goal. We should be able to do our homework otherwise. Go ahead if there's another highlight that you wanted to capture at all or to share.
Nope, that was it. I mean,
Yeah, I think that's sufficient. Did we get a second on the?
I did. Mr. Ru seconded.
Okay, great. Would you go ahead and do the roll for us?
Ms. Ginsburg?
Yes.
Ms. Mead?
Yes.
Ms. Martin?
Aye.
Mr. Green?
Aye.
Mr. Fay? Mr. Gatto?
Aye.
Okay, and Chair Jones?
Aye.
Okay, the motion passes unanimously.
And now, thank you. And then on to the benchmark presentation.
Yeah, so Chair Jones and trustees, so similar to the last item, this recommendation is to approve the policy benchmarks for both the pension and the OPEB trust. As part of the discussion over the last few months, we understand that reviewing benchmarks is an important part of the SA study to ensure that we have an effective benchmark in order to measure performance, as well as it's a key tool in monitoring the portfolio as a whole. So Makita did a similar benchmark presentation earlier this year where Tim and Ison provided some education. So I'm going to hand the presentation over to Tim and probably walk through some of the changes that we've made to OPEB as well as the pension plan.
Perfect, thank you. In sort of lieu of the other presentation being given in January, we did include some summaries of that material at the beginning, but I think I'll maybe skip to the punchline overall, because we've definitely talked a lot about the importance of benchmarks, conducted the overall review, and I'll just share with the group the high-level conclusions, and we can dive into some Q&A after I go through that, if that's okay with everyone.
Yes,
Perfect.
please proceed.
If we could move the slides to 9. Thank you. So these are the pension proposed benchmarks. So I'm going to just focus on the third column from the left, which is the proposed benchmarks. So this aligns fully with the functional categories and subcategories. Within growth, you can see that all of the proposed benchmarks are the same, which means basically no real shifts to either our view on capital markets or the proposed benchmarks. We think those are all appropriate as previously approved. Just moving down the functional category list, we get to the credit category, and you will notice a change here to a new benchmark. So for credit, in the previous allocation, we had discrete allocations to both liquid and illiquid credit, each of which had separate benchmarks. So you can see on the current benchmarks, that is a long, complicated item there that reflects both the liquid and the illiquid benchmark. So that's all being collapsed into one category. And with the sort of change to more illiquid credit, where that sort of direct lending, floating rate market is a much higher weight, we're recommending going with a 70% to Credit Suisse leveraged loans, which is essentially floating rate instrument standard benchmark, and 30% of it being tied to the Bloomberg US Corporate High Yield Index. That's the standard index for high yield. And then utilizing a 1-month lag to reflect the fact that the majority of the assets in this category will be on a 1-month lag. And then having 100 basis points of premium, again, to ensure that LACERA is capturing the illiquidity premium that is in the market So that's the recommendation there. Any questions on credit?
Trustee Mead, did you have a question specifically on credit or?
It's for the other one. Oh, wait, not for credit.
For the other one? Okay, perfect. Yeah, and the other thing that you'll notice on this one is there's no longer an explicit allocation to emerging market debt. That's going to be handled in individual manager mandates and guidelines, and they'll have the flexibility to implement there when they believe tactically appropriate. But it is no longer part of the strategic asset allocation as we discussed last meeting. So that's credit. So real assets and inflation hedges, core real estate, we made no change. Natural resources, there is a change. The main one being that there's no longer in that the category previously was called natural resources and commodities. We have eliminated the commodities allocation from the overall program as part of the newly approved strategic asset allocation. So that's missing from the new benchmark. And it's shifting to now 65% global natural resources and 35% to Neck Reef farmland. Neck Reef is an organization. It's essentially the same approach. It uses a peer benchmark approach similar to what the Odyssey is to capture the farmland investments that LACERA has made and plans to make. So that's the change for natural resources. Okay, moving on to infrastructure. The only change here, as the infrastructure allocation was added with the last strategic asset allocation, there was a primary mechanism for implementing that was through public markets and then transitioning to private markets. So the only change here reflects the continued maturity of the program. So adding in a 3-month lag to it to reflect that the program has matured and is mostly now in private market instruments.
Yeah.
Moving on to TIPS, as part of the strategic asset allocation, we modeled short-term TIPS. Basically, longer-term TIPS are dominated by their interest rate exposure and duration risk. So this time, to more capture within real assets, we narrowed that to just using short-duration TIPS. So you're capturing more efficiently the CPI adjustment mechanism and not having as much overall interest rate risk. And so we are changing that benchmark to simply reflect what was modeled in the strategic asset allocation.
All right, Trustee Mead, was this the section that you had the question on or no?
Okay, not quite there yet. So risk reduction and mitigation within investment grade bonds, no change there. We're still sticking with the Bloomberg Ag, which is the standard for that category across the industry. I guess I'll say the same thing for long-term government bonds, no change there. Cash, no change there. Those are standard benchmarks used broadly throughout the industry. The hedge funds is where we did make a change, and this was driven by the changes in our capital markets expectations. As you all recall, we're in a much higher interest rate environment than the last time we did the strategic asset allocation. So cash yields are projected to be a little above 4%. In our previous allocation study, it was only around 2%. So the way that LACERA implements their hedge fund program is truly meant to be risk mitigating. It's meant to have a lower negative correlation to risk assets. It's also meant to have very low beta. So it's not trying to shoot the lights out. It's just trying to provide a defensive alternative to some of the other instruments within the category. So we thought it made sense, just given how much more of a burden that cash return is based on our capital markets expectations, to reduce that to give the team a more effective chance of meeting that benchmark without forcing them to take additional risk that we don't think it's designed for.
Okay. All right. Trustee Mead.
Thank you, everyone. So that's exactly where I have my question at, the hedge funds. I see, the benchmarks reduce the base point, reduce from 250 to 200. You're saying the reason reduce is because the high interest rate environment. Because that we want to lower our standard expectation of performance? A little bit.
Well, we don't necessarily, we want to lower the relative performance expectation and not force the hedge fund program was designed to be very defensive in its nature. And now, if the previous expectation was 2 plus 250, so 4.5%. Now, if we take cash yields, you're talking about moving up to 6 or perhaps 6.5%, or 7 with the old target. That's starting to get into a category of risk that I think is going to force them to change the nature of the program, which the hedge fund program has been a tremendous source of stability and value add. So we didn't want by not moving the benchmark, we didn't want to change the implementation essentially.
At least based on how our hedge funds, what it's designed for, what we intend to do. So makes sense. Thank you.
Yeah, if we started chasing these much higher returns, you're going to start to get much more equity risk into the hedge fund program and other things that we think are reflected elsewhere in the portfolio.
Thank you.
So that's the proposed pension benchmarks. And then I think we can just do the same thing, maybe a little bit quicker on page 11 for the OPEB benchmarks. Similar exercise here. So we're going to focus on the proposed benchmarks, which is the third column from the left. Within growth, no change to any of those. The changes made to the credit category are the exact same as those proposed for the pension to reflect the collapse of the illiquid and liquid credit categories into one category credit. So that's the exact same change there. Real estate, we have shifted in this portfolio to, this is another one where in the OPEB's early days of investing in private markets, we had a benchmark that was part private, part public. Now that that program has matured, we're just switching to 100% the Odyssey. So that's that change. Natural resources is the same. Infrastructure is the same recommendation we made for the pension. Essentially, that program has matured now, so moving to a fully 3-month lagged index just to account for the timing of the reporting there. TIPS index, same change, and then within risk reduction and mitigation, no proposed changes because there are no hedge funds within that group.
All right. Any questions for Tim?
Thank you, Tim. I'd like to move to adopt staff recommendations, please.
We need a
A
second.
second.
Okay. Ms. Ginsburg,
Yes.
Ms. Mee,
Yes.
Ms. Martin,
Yes.
Mr. Green, Mr. Fay, Mr. Gatto,
Aye.
Mr. Rue,
Yes.
Mr. Jones.
Aye.
Okay, the motion passes unanimously.
All right, outstanding. Next up, we have a presentation regarding the staff recommendation for actuarial consulting and auditing services. Search. Morning, Ted. Morning, Laura. See you guys settling in there.
Good morning,
Okay.
Chair Jones. Thank you. And good morning, trustees. Before you today are staff recommendations for the selection for LACERA's actuarial consulting services and actuarial auditing services. The consulting actuary is primarily responsible for our annual valuations, experience studies, regulatory disclosure services for the pension fund and for the other post-employment benefits or OPEB fund. And also they do additional consulting actuarial work as required. The auditing actuary is responsible for independently auditing the work of the consulting actuary with respect to their primary responsibilities. Today, Catherine Ton will go over our procurement and selection process. Ted Granger will discuss our recommendations for our consulting actuary, and Richard Bendel will discuss our recommendations for our auditing actuary. If we could go to slide 3, please. Thank you. So the staff issued an RFP for these services, and the team unanimously recommends awarding Milliman a 5-year contract with 2 one-year options to extend for our actuarial consulting services. And we also unanimously recommend Kavanaugh McDonald or CAVMAC for a 5-year contract with 2 one-year extensions for our actuarial auditing services. Milliman and CAVMAC both happen to be our incumbents, and Milliman has been our consulting actuary since 1999, while CAVMAC has been our auditing actuary since 2017. The team did confirm that unlike our financial auditors, there are no professional standards that limit the amount of time that actuaries should be in place. And most funds actually find a longer term relationship advantageous. So I'm going to pass the baton now to Catherine, who's going to talk about our procurement and evaluation services.
Thank you, Laura. The purpose of the search was to select one firm for actuarial consulting services and a separate firm for actuarial auditing services. The table below provides insight into the actuarial services reporting cycle for the retirement plan and OPEB program. This is done on a 3-year cycle. If you look at the column on the left, in the first fiscal year, the actuarial consultant is required to perform an actuarial evaluation as well as provide GASB disclosure reports and routine services. In the second fiscal year, the actuarial consultant is required to perform everything in year 1, plus the actuarial auditor provides GASB disclosure reports. In the third fiscal year, the actuarial consultant performs everything in year 1, plus an experience study. The actuarial auditor performs a concurrent independent review of the consultant's actuarial evaluation and experience study. This slide provides a high-level summary of the scope of services. Both the consulting and auditing services would require an annual actuarial evaluation, a triennial experience study, and GASB disclosure reports. The main difference is that the actuarial consultant would prepare these items, whereas the actuarial auditor would use the consultant's data to perform an independent review. In addition, the actuarial consultant will consult with staff and trustees on benefit matters, regulations, and administration of the retirement plan and OPEB program. Because actuarial consulting and actuarial auditing services touch various stakeholders, the evaluation team consisted of key division heads throughout LACERA. The evaluation team consisted of members from the Executive Office, the Investment Office, Legal, FASD, Internal Audit, and Retiree Healthcare. Let me now speak on the RFP process. The proposals were scored based on 4 main categories. The organization and team were equally weighted at 25% each. The approach and sample reports were weighted at 40%, and fees at 10%. This slide shows the sequence of events from launch of the RFP to the different phase levels. Phase 1 is the proposal reviews and selecting the finalists. Phase 2 is the firm interviews and presentations. Phase 3 is a post-interview follow-ups and due diligence, up to the recommendation to the BOI today. This slide shows the firm's scoring during phase 1 and 2 of the RFP process. The top half of the page shows the actuarial consulting scores on a 100-point scale. In phase 1, LACERA received 3 proposals and advanced 2 firms. In phase 2, the evaluation team found Milliman to have a strong team and bench strength. Let me now focus your attention on the actuarial auditing scores in the bottom half of the page. In phase 1, LACERA received 2 proposals and advanced both firms. In phase 2, the evaluation team found that CAVMAC had stronger presentation skills and their team reflected dedication to Seral experience. This page shows the phase 2 scores in more detail. For each bar chart, the horizontal line shows the 4 evaluation criteria and their weights. The vertical line shows the scores. Milliman was a top performer in 3 of the 4 categories. Milliman scored lower in fees, but their cost was within 5% of the other bids. CAVMAC was also a top performer in 3 of the 4 categories. CAVMAC scored lower in organization background because they are a boutique firm with less history. In the end, Milliman and CAVMAC both finished with the highest total weighted scores. I'll now hand it over to Ted, who will talk about Milliman.
Great. Thanks, Catherine. Good morning, Chair Jones and trustees. Thank you. Milliman is one of the larger firms within the industry. They do have a significant focus on actuarial consulting services. They have served as the consultant to 6 of the largest public pension plans. Each member of the proposed team has between 5 and 36 years of experience in terms of actuarial consulting. We'll talk a little bit later about the lead and supervising actuaries, but they have worked together for over 15 years. In terms of the track record with LACERA, we believe that Milliman has achieved some notable accomplishments and reached some major milestones in terms of working with LACERA. First, on the pension plan side, there was PEPRA and the implementation of that back in 2013. There was some analysis and some cost measures that Milliman had to work with LACERA on to determine if our current plans were cost effective. They were determined not necessarily to be, so LACERA had to establish 2 new retirement plans to which Milliman made sure we complied with the law with respect to cost. Another notable accomplishment on the OPEB side was the implementation, and I think I sound like a broken record, but the implementation of GASB 74 and 75. Those 2 standards were implemented in 2017, 2018. Milliman developed custom reports for LACERA and also for the plan sponsors to provide the information necessary for our financial statement reporting. So we've definitely had some significant projects for Milliman over the years. Next slide, please. In terms of Milliman's commitment to DEI, in addition to the information presented in this slide, we also had some additional conversations with Milliman. They did hire a DEI officer in 2022. Milliman also conducted an internal study on how to increase the number of women and people of color at the higher ranks within the organization. They did establish internal organizational goals to meet those results of the study. There's been no major legal actions with respect to EEO claims since they began tracking this information, and we concluded that Milliman has established a formal DEI program within the firm. Next slide, please. Milliman does have a strategic approach in keeping up with industry trends and changes. There's an internal group that meets monthly to discuss public employee retirement plan issues. That information is then disseminated to the consultants throughout the firm. There's also an annual educational conference where the consultants on the healthcare side and the pension side come together and meet to discuss current industry trends, actuarial assumptions, funding policies, healthcare regulations, et cetera. And LACERA is very aware of this conference because Milliman denies us our meetings during that period, so they do take it very seriously and they do attend those events. Next slide, please. In terms of strengths and concerns, Milliman does have an excellent working relationship with LACERA, especially on special projects. The firm has added new people to the teams over the years. We believe they're highly qualified individuals. For example, on the pension side, Milliman, we started out in working with Karen Steffen for a number of years. She was on the LACERA account for about 12 years. Mark Alleman then took over as lead consultant. In the background during those years, Nick Collier was working on the account, and he is now the lead consultant. So he's been a part of the relationship since the beginning. And Craig Glide, he's been on the accounts for 9 years, and Craig works with Nick very closely. One mitigating factor to retaining the relationship with Milliman over a long period, and that is our actuarial auditor. We started out with Siegel back in 1999. They've been our actuarial auditor since the beginning. Then we switched that relationship over to Kavanaugh McDonald in 2017. So during that period, we really had no major audit findings, but we have had the audits done every 3 years when we have the experience study completed. So every 3 years, there's an audit an audit has been done by one of these firms. Next slide, please. In terms of the proposed team, this is actually one of my favorite slides. I feel like we're getting sort of 2 firms in one. On the left-hand side is the pension team in green. They obviously specialize in public employee retirement systems, and they have just been a tremendous team to work with. On the right-hand side, we get a whole separate team for the OPEB program and working with the county on that program. We really feel like this balances the work with both at LACERA and within the firm. And so we're not overloading one particular team with all of our projects and all of our requests. We also think that this provides some different perspectives within the firm. We often hear them talk about how they're talking amongst themselves. The pension folks are talking to the OPEB folks. They're figuring out what each other is doing, what the reports look like, what might be the best method for LACERA and the plan sponsor. And one final thought on this slide, having the separate OPEB team has been very beneficial to the county especially. There's a lot going on with healthcare. There's been a lot going on over the years. I mentioned OPEB, Tier 2, OPEB Trust, agent plan reporting, potential changes in benefit structures for the OPEB program. We have, Milliman has just been extremely responsive. They've been thoughtful in their approach, and we've really appreciated their support, and I think it's been beneficial for the county as well. Next slide, please. So this slide shows the fees for the 5 years. You'll notice a couple of spikes in terms of the increases in fees. That is for the years when we conduct the experience study on both sides. Those studies are staggered, so there's different years when the fees increase. We also would note that on this slide, there's a lot of other projects that Milliman does for LACERA besides just the formal reports. So for example, the 415B testing for our benefits group, the actuarial table updates for our systems group, and the STAR evaluation, which is part of a memo that I present to the Board of Retirement. These fees were based upon a competitive bidding process. They are within about 5% of other competitors. We would also note that we compared these fees to the prior contract, and they increased about 5% over that contract. Next slide, please. Okay, so this slide's a little bit complicated. This is our calendar of projects that we work with. The top half is on the pension side or the retirement benefit plan. The bottom half is the OPEB program. I think a takeaway from this slide is that Milliman and LACERA are working together pretty much nonstop throughout the year on these various projects. And one final takeaway is the green triangles essentially represent when reports go to the boards. And so you'll see that in December, March, and June, for example. On the upper half of the chart, these are when pension reports generally come to the board. And so with that, I'll hand it over to Richard to talk about the actuarial audit services.
Thank you, Ted.
Actually, could you hold on, Mr. Bendel? I just got a question for you, Ted, if you don't mind. As it relates to Milliman, and I think appreciate you, Lauren, mentioning it up front, because it was one of my questions as I was reviewing this ahead of time was, what's the best practice for kind of incumbency? You know, at what point is the, you know, does the relationship kind of plateau out from new insights or whatever else, given the pain of switching costs? So I appreciated you mentioning the kind of standard practice there. But then my next question would be, given that we're staying with the incumbents, then what's kind of the enhanced expectation of improvement in the new contract? Is that something you can share with the board? I mean, I realize that there's already a close relationship. There's special projects beyond the obvious, but at the opportunity of renewal, what's kind of the enhanced expectation of improvement for things that you might be able to share with the board so we can kind of be mindful of that in the relationship as well?
Right, and thank you, Chair Jones. There's not necessarily a best practice in terms of keeping firms over a set period. Really, the best practice comes into play. For example, GFOA recommends the actuarial auditor to be invoked. And I believe their cycle or their recommendation is about a 5-year audit cycle. LACERA has a little bit more robust cycle. We have the auditor come in every 3 years when we perform the experience study. As far as new initiatives and renewing the relationship, we haven't given that a lot of thought at this moment in time, but I think should the board approve this, we will definitely give it some thought in terms of our team here internally, and we will also talk to Milliman about what we might be able to do to improve the relationship and improve reporting. I think there were a couple of internal comments about simplifying reports that might be on our list, presentations in terms of making sure they're concise and relevant for the board. That was another thing we talked about as we did the evaluation. So I think there's a couple things on the list, but we probably should formalize those in talking with Milliman.
Yeah, I'd like to know that. I think that would be helpful for us just to know, just in terms of just raising the bar. I mean, I realize they're already doing a great job. I've appreciated Nick's presentations whenever he comes before us on that part of it, but there ought to be some kind of enhanced expectation as we move forward into the next contract. And I'd just be interested to have you share that with the board.
Sure.
Okay. I'm sorry, Mr. Bendel.
Good morning, Chair Jones and trustees. As Catherine mentioned, CAVMAC is a boutique firm, but they do have 35 actuarial professionals focused wholly on providing the relevant actuarial consulting and auditing services. The 9-member LACERA team has a breadth of qualifications and significant depth of experience. The firm has a broad base of experience in both pension and OPEB work in the public sector. And CAVMAC has demonstrated their technical experience working with LACERA for the last 7 years. On this slide, of note on the slide really is that CAVMAC has equal opportunity and equal employment opportunity and non-discrimination policies. The firm is over 50% female and 30% woman-owned. The firm has increased the proportion of minority employees over the past 5 years. In our interview with the firm, they expressed their commitment to diversity and in their ongoing efforts of recruiting and hiring, and they expressed that they're actively trying to continue to diversify their workforce. As a small firm, they indicated they're more competitive at attracting candidates out of college than as opposed to mid-career candidates. So they bring them in and train them up. Finally, there have been no EEO claims against CAVMAC since the inception of the firm. As a smaller firm with fewer resources, CAVMAC has demonstrated their commitment to cybersecurity, and they continue to demonstrate that commitment. While they do not obtain an annual SOC 2 performed of their security structure, they did participate in completing LACERA's alternative process, which is the vendor data security questionnaire. They worked with our IT InfoSec group, and our InfoSec group worked with CAVMAC management and their IT consultant to vet their security structure, and our team feels confident that they are secure. Next slide. CAVMAC is a small firm, as I mentioned, but has a large engagement team dedicated to LACERA with a broad base of relevant experience, and I think we'll see that on the next slide as well, which depicts the team there. And again, depicting that they have experience ranging from 6 to 36 years. We have worked with Brent Bannister, who's been the lead with us for the last 7 years, him and Pat Beckham. But overall, it's a very strong team. One more point on that one, but just they don't have any retirements planned, but they expressed their commitment to succession planning, and we feel that was demonstrated in the team that was proposed. CAVMAC's proposed fees are slightly lower than the current contract. Of note is, in our experience with the firm, if they find efficiencies and complete the work in less time than anticipated, they have billed us at the actual amounts and not automatically billing us to the proposed fees. So I think that really speaks to the integrity of the firm as well. And then the last slide is the one that Ted went over earlier. The only difference here is that it also depicts the red triangles, which is the Kavanaugh McDonald presentation of their work or to LACERA and to the boards. And with that, I'll pass it back to Laura to sum it up.
Real quick question, I'm just, on the fee structure, is that what is being identified on slide 25, the gap in year? Where to go? All right.
The reason for the gap is for CAVMAC, as an actuarial auditor, 1 year they would perform the study for the retirement plan. The next year they do it for the OPEB program, and then they take a year off. So if you look at the retirement plan, it's like $127,000 for year 2, and then it's 3 years later, and it's
Gotcha. Okay, sorry. Yeah, thanks. I didn't connect the two there. I see your foot
And so similarly, Mr. Bindell, let me ask you the same question on the opportunity to kind of re-up an incumbent. Are there were there any discussions, kind of going forward, kind of enhanced expectations for additional support or additional, analysis or anything else that you kind of envision, beyond the good level of performance and service that we've got to date that you would anticipate and communicate to us that you would expect to see in the next, 5-7 years going forward?
There's nothing really that comes to mind. I think they've demonstrated their flexibility and availability. I think maybe Laura has, were you?
I would just add one area that they have already stepped up and that I think we'd like to acknowledge is really a significant focus on improving their cybersecurity stance. They've increased their insurance coverage and really worked with us to make sure that the LACERA data is safe and secure. So that commitment, the team was really impressed with just how collaborative they were in that process and definitely showed an additional commitment in that area.
Absolutely.
And just kind of adding to what Laura mentioned, Chair Jones, I think both firms have really stepped up in terms of DEI. In speaking with the DEI officer, they've hired the DEI officer in 2022, and they've increased the number of employee resource groups that they had, most recently an Asian resource group, and they also have like 7 other groups formed. And then in terms of CAVMAC, they're really boosting their recruiting efforts at local universities to attract people of color.
Fair enough. Thank you. Any other questions by my colleagues at all? Anything?
I have a question.
Yeah, Trustee Me.
Hi, thank you for presentation. Have 2 questions. I will go one at a time. I'll go the easy one first. I look at the term of the 2 contract, right? It's a 5 years term and then 2 years optional years. You talk about the cycle earlier being 3 years, right, for our work cycle. Wonder is the reason why we chose 5 years to be the contract terms and 2 years option year. Maybe it's related to negotiation or what that is. Just wonder if was the reason.
I think the 5 years is really commensurate with the board's wish for all contracts to be on a 5-year rotation policy. We used to do it 2 3-year terms for the actuarial contracts, so 6 years. But actually, the 5 and 2 worked really well this last time too, because we're compliant with the board's 5-year policy for contracting, and also because the triennial for the pension is a year lag to the OPEB. It just works well. And I think it'll happen again this time, right? We'll have the triennial in the 6th year and the triennial for the OPEB in the 7th year. So it fit really well with the work and the calendar of work.
I'm still a little bit new to the policy. Do you mind to elaborate on the 5 years policy?
That's a board practice for most of the contracts. I don't know if I could speak to it more than that. I know the board, they really opposed to having just evergreen or long-range contracts, but that contracts get vetted or go through the RFP process on a 5-year basis, no longer than that. And there are exceptions to that, but generally that's been the board of retirement and board of investments practice. Yeah.
Thank you. My second question is, I will go to the memo on page 2. They have a really good summary table on their chart 1 on the both company, their fee. My question is, the retirement plans is much, much larger than OPEB, right? So it makes sense when I see the fee for CARMAC, they have lower fee for OPEB, higher fee for retirement plan. However, we'll apply the same logic and look at the Mulliman. So I'm a little bit puzzled there why OPEB program fee is much, much higher than retirement plan fee there. So share what you can, in the public section. So maybe there's a communication and negotiation over this that might not be able to share, but that caught my eye.
Yeah, okay, so in terms of the differences on the consulting side of Milliman between the pension and the OPEB program, LACERA has a complicated OPEB program. it requires additional work from the consultant. Just a couple of things to point out on the OPEB side. We have a medical plan, a dental plan, Part B reimbursement, and death benefits. Those are just the group of benefits. We also have a two-tier structure. We have members that are in Tier 1, and then after 2014, members that are in Tier 2. So there's two different benefit streams with respect to the members. There's pre-65 members, post-65 members. So all of these things are going into the calculations and the analysis that Milliman has to do on our program. As I mentioned earlier, there's the agent employer reporting structure. So once they've done the analysis on the demographic piece, when they're putting the reports together, there's actually separate reports for the employers. Claim costs among multiple healthcare providers. We have many different plans that we offer. Milliman has to analyze those claim costs for each of those carriers. And finally, the stakeholder group, and this is one of my favorite parts, and that is we work with the county. We're administering this actuarial studies and actuarial process and this program itself, the RHC program itself, on behalf of the county. So when we put together our stakeholder group, there's about 9 or 10 participants in that group that we come together and we vet all of this stuff, if you will, through the process. So it starts to add up and it becomes a little bit less routine than the pension. That's why there's additional costs.
But this is not the case for the CARMAC. The OPEB program is less work.
I think on the audit side, it's a little bit more streamlined. They have the one team and they're able to vet more in terms of they see it as more of a comparable in terms of the audit process, right? If their audit process is a little bit more parallel to on both plans.
And just to add to that, Trustee Mee, if you look at the OPEB fees, it is slightly higher than the retirement plan by maybe about 30,000. So it is reflective of the additional time and resources just based on the larger set of stakeholders and the agent structure of the OPEB program.
Makes sense if the scope of work, even a smaller plan, but the scope of work is much more complicated, much more layers to it. So yeah, it's about 450,000 more. So thank you for the explanation. It makes sense.
Okay, Trustee Ryu?
Thank you, Mr. Chair. For the actuarial consulting, 3 firms applied and 2 firms applied for the auditing part. What's the pool of companies that could actually apply?
So the pool's 8 firms, so it's pretty small, but in terms of the RFP, only 7 firms were eligible because we didn't include LA County's actuarial consultant, so it was a pool of 7.
For each one?
Yes.
Okay. And you mentioned, one of you mentioned earlier that our contract is 5 + 1 and you said on for these contracts, a longer term relationship is desired. What's the industry standard for other pensions when it comes to actuarial consulting, actuarial auditing services? What's their usual relationship?
I would say for the general finance, the GFOA, as a best practice, they recommend that when we launch an RFP, we do it together with the actuarial consultant and the actual auditor, RFP together. I would say, given that we do have Milliman as a long tenure of like over 25 years, it provides that stability. CAVMAC, they were a new firm in the prior contract in 2017, but given that they were just much more experienced, like seasoned members, we thought that as an actuarial auditor, it makes sense to keep them because they're just kind of working concurrently with Milliman. Are there any additional thoughts from the team?
Well, actually, let me rephrase the question.
I think you.
Yeah.
So I think I understand your question a little bit different, which was sort of how long should the RFP cycle be?
No, not that, but our with
Duration.
Milliman is 25 years, and with Kavanaugh, it looks like it's 2017, 5 years. Especially for the auditing firm, I guess the industry standard would be to refresh it with a new firm. But then in this case, other pension plans, they have 20-year relationships with their auditing firm and 20 plus years with their consulting firms?
That's pretty common, yes. So most other firms tend to have long relationships, in part because there's a small pool, but also it takes a while to really get to know the benefits that are offered. Different plans, LACERA has a pretty We have a lot of different tiers, a lot of different benefit structures. The OPEB was one part of it, but on the pension side, obviously, we have safety plans, several safety plans and several general plans. So having that understanding of the benefits that are offered really makes a difference. And it takes a while for the actuaries to learn that. There's also a capacity issue. So these firms, have to be able to support their work. So there's a lot of work out there and not a lot of firms doing it. So I think that also speaks to maybe why some of the firms didn't apply.
And then slide 10, just two more quick questions. Slide 10, it looks like for the actuarial consulting, Willman had a cheaper price fee proposal, while on the auditing side, it's CavMac had the cheaper fee proposal. Is that how you read it?
Yes, that's correct.
Okay. And then slide 9, the one right below it. It looks like, especially in phase 1, the scores were pretty tight. But for the auditing services, what was the different? Was phase 1 and phase 2 criteria different, or the?
It was similar criteria, but for phase 1, it was solely based on their submitted proposals. And for phase 2, it was the interviews. And in addition to the interviews, we had each firm prepare an educational piece where we gave them a topic of ASOP 51 to present to the evaluation team as well.
Because in the auditing, Buck actually scored higher, 83 to 80, and then it just flipped on phase 2.
CavMac really excelled in that presentation on the ASAP, but probably the best one that we got, and really just the strength of the team, and Catherine mentioned earlier too, their experience with 37 Act funds. It did flip for us. I think unanimously flipped for us.
And another explanation is based on the proposals, CavMac, they didn't provide as much color in terms of their IT controls, but then during the due diligence process, we did have them speak with our InfoSec team, and then they did perform like a risk assessment of CavMac, and they thought that their controls were adequate, and given that it reflected in the phase 2 scores, in addition to just the educational piece that Richard touched upon during the presentation.
Okay, well, yeah, hopefully, it makes logical sense to have Kavanaugh and especially having that continuity, but but we do want to encourage in the future that more people apply, and it looks like, Buck did a great job, right? So I'm sure Kavanaugh is doing a great job, but at the same time, we want to have robust responses to the RFP in the future, but I get it, there's only 7 firms.
And if I can point out, all 4 firms, they were outstanding. All of them would do an outstanding job for us. As we recognize that technically they can all perform, the real game changer for us is that education piece for trustees. It is really important as you're making these decisions that you understand what's before you, and that what's at stake. We have a lot of new trustees, so we want to make sure that folks who are presenting in a clear, concise manner that's going to assist you. And while they all were able to do that, as Richard pointed out, Kavanaugh McDonald, theirs was really, of all firms, was the most, we found the most easily understood presentation. And we think that makes a big difference for the experience that all of you have, and the public who's also experiencing this and needs to understand the matters before the board.
Okay, thank you.
Trustee Green?
Yeah, I really appreciate the questions. It's to be thorough, and I maybe have some information because I seem to recall the question of the time in the RFP process and the 1-1 extension and whatnot, and I don't recall what BOI meeting it was, or committee, or offsite, but the relationship, it was brought up. And correct me if I'm wrong, bringing in a new set of eyes, right? Like what's the impact of not? And I guess I want to preface all of this with that I feel confident in the RFP process by staff, that it's fair and it's thorough and well thought of, and not haphazard in any sense. But that was the balance, was the, relationship with nuance, of our fund, and that relationship, between both OPEB and whatnot, and also having, some fresh blood come in. And it's not just the triannual fit, right? I mean, we also have a post-PEPRA annual that has to go. And in the fire service, we call it staying connected to the incident, showing up at the incident every day, not showing up 2 days later. You're in real time. And the higher frequency of that for all things PEPRA, I think, that also helps with, I don't know, maybe a look into the future and seeing where things are going, because they've been attached to it. With a 3-year or any other, I would have a concern that, PEPRA things and whatnot, there might be a gap. I mean, imagine if an RFP process went in, leading up to our 3-year, our triannual assessment, and compounded by having to do one annually. So I think those were some of the talking points that came out. And I don't know if that sheds light on it. Gosh, I don't even know what meeting that was. Maybe I dreamt it, but I hope that helps. So if I'm off base, please feel free to correct me in any area.
Do we have a motion to accept staff recommendation?
I'll move.
I'll second.
Ms. Ginsburg?
Yes.
Ms. Smee?
Yes.
Ms. Martin?
Aye.
Mr. Green?
Aye.
Mr. Fay?
Aye.
Mr. Gatto?
Aye.
Mr. Rue?
Yes.
Mr. Jones?
Aye.
Okay, the motion passes unanimously.
And just to make sure it's noted that I'd like to the extent it's possible from both Mr. Bindel and Mr. Granger to get some communication just in terms of how we expect to grow on the great base of relationship we have with both of those firms kind of going forward. That'd be great.
Yes. Sounds good. Thank you.
Thank you.
All right, moving. So we've got the administrative issue here that we need for Trustee Trevor Fay. It sounds like some junket to New York he's trying to go to. No. Toigo Foundation is obviously has done great work for 35 plus years. Glad to see someone from our board going to represent there as well. But do we just need a motion, Linda?
Need a motion. Yep, that's
Okay.
it.
Yeah, can we get a motion?
I can move to motion.
Second.
Okay, and Ms. Ginsburg?
Yes.
Ms. Smee?
Yes.
Ms. Martin? Yes. Mr. Green?
Aye.
Mr. Fay? Aye. Mr. Gatto?
Aye.
Mr. Rue?
Yes.
Mr. Jones?
Aye.
Okay, the motion passes unanimously.
All right. Super. So did we have any need to pull any of the reports? Are we good on those at all? Linda?
Nope, we don't have any requests from the trustees to pull any other reports.
All right, items for staff review.
You mentioned you would like communication regarding both firms and the growth.
Yep. And just share with the board, please. Yep. Items for future agendas.
Nothing.
All right, and then go to the order,
Would you like me to call on the trustees?
if you don't mind.
Sure. Mr. Green?
Yes, thank you. Happy Mother's Day to all the mothers coming up on Sunday, and happy Mother's Day to my mom.
Mr. Fay?
Second.
Mr. Rue?
I always like going later, but so thank you for that. Yeah, happy Mother's Day to my wife and to my mother.
Ms. Smee?
Well, +1. Happy Mother's Day for everyone, all the mothers, and your guys' mother. And yeah.
Ms. Martin?
I'm going to say happy Mother's Day to me, right? Okay, anyway. Appreciate today's presentations. Very insightful, very informative.
Ms. Ginsburg?
I echo everybody's comments.
Mr. Gatto?
I too am in favor of others. Apple pie too.
Santos, John, anybody? Okay, John?
Obviously, happy Mother's Day to all. Also, I want to recognize Didier Acevedo. Didier, who is a investment officer focusing on private equity, who happens to be another Twigo Fellow. Didier was just added to ILPA, which is the Institutional Limited Partner Association, which is a key organization, a key partner of LACERA's. He was added to their steering committee for their diversity in action initiative. So thank you, Didier, for representing LACERA.
Chair Jones?
Yes, and then wonderful job by staff and our consultants leading up to this meeting. A lot goes into it. I know I only see a portion of it, but just appreciate all the efforts that goes to make this as productive and as coordinated as possible. Number two, likewise, Mother's Day to my lovely wife and to my mother, who still has no clue what I do. And then thirdly, in celebration of Asian and Pacific Islander Heritage Month this month, I am married to a wonderful Asian Pacific Islander. Filipinos are kind of all over the place in that regard. So just celebrate that. And then, of course, Trustee me and her wonderful heritage as well. So and then outside of that, then we'll have closed session. Let's take a 10-minute break and come back at 11:05. So that gives time to clean the room and bio breaks and everything else otherwise to there. But thank you very much for an outstanding meeting. First after meeting, we look forward to seeing you in a closed session. Okay.
Recording stopped.